Hello and welcome to the Creative Financing Podcast. I'm your host, Jonathan Gallegos, here with
Jeff Rappaport.
And today, guys, we're doing a video series, and this is going to be on the various creative financing strategies. Jeff, you want to start?
You broke up there a little, Jonathan.
I said, do you want to start?
Sure. So what we're going to do today is go over the different types of creative financing and quick overview, and you can always go back to our podcast and check out some of our earlier episodes where we go into depth about them.
And we wanted to do a video series for you guys so we can kind of give you the visual component of what the strategies are and how to use a financial calculator, and we're going to even get into some offers later on so that you guys can kind of see it.
That's right. So you want to dive in?
Yep, let's do it.
Okay. So the most common used types of creative financing are contract for deed, land contract, and agreement for sale. Those are basically all the same thing.
With a different name.
They go by different names, and they may have slight variances, but it depends on what part of the country you live in.
Right.
So we'll go through what those are and how they kind of differ from some of these other ones. Wraparound mortgage and all-inclusive trust deed and note. That's when we're creating a note around an underlying mortgage or trust deed.
Right.
Subject to the mortgage. That's the one that probably most people are familiar with. Subordination, where we get the seller to take back a second mortgage for their equity. And then the lease option or rent-to-own situation where you're not necessarily the owner, or you could be the owner, depending on the situation, but leasing it with the option of buying.
Right.
So before we really get into what they all are and how we can use them, we should understand something about the due on sale clause. Do you want to talk about the due on sale clause, Jonathan?
Yeah, so the due on sale clause is just what it states. If you if you transfer title, when you get a loan from a bank and you transfer title of the property, the bank has a clause in all loans issued today that states that principal balance will be due upon a sale. So if title is transferred, the bank can call the note due, and they'll demand the full principal balance, whatever's left of the principal balance, paid in full, or they can go the foreclosure route on you.
What do you think is the chance of that happening?
So it's very, very slim, and there are a few banks across the nation, probably I know here in Utah we have a specific bank that will call a note due, but there's a very slim chance of a note being called due, and there are a couple things that you can do to protect yourself. And one of the strategies we teach is contract for deed, in which title doesn't transfer. That's one way, just as an example. But the chances are very slim. You should be aware of it. You should disclose it, but you should not be scared or afraid to use creative financing strategies because of it.
I would agree with you. I've been doing this for 19 years. I've had one loan that wasn't even called due. The bank contacted me and they let me assume that loan with no qualifying. I gave no paperwork. I just signed some papers and they were fine with it. And I know others that Dave Kenny, who we've interviewed before on our podcast, he was talking about that he had one loan threatened to be called due, and they called him. He told them yes, he was the owner, and they said they wanted their money, and they sent him something in the mail, and he ignored it, and they went away, and he continued to make payments. So it is not something that you should be worried about, but yes, you should be aware of it.
Right, and you should disclose it.
Yes.
Cool.
Let's talk about the contract for deed or land contract or agreement for sale or anything else that it might be used as across the nation. And it's a very simple explanation. It's exactly like buying a car.
Right.
If you go down to a car dealership, Jonathan, you wanted to pick out a car and you actually had to get financing on it, so you needed a bank to give you a loan so you could purchase that car. You are the owner of that car when you drive off the lot. However, who is holding the title to the car?
The bank that issued the loan for that car.
That's correct. So contract for deed, land contract, basically what happens is that if you are selling the property on contract for deed, your buyer now owns it, but they are not showing up on title. The seller remains on title, and the deed is actually held in escrow, signed, but it only transfers once that entire amount is paid in full.
Right. Yeah, and that's such a simple way of looking at it. It's just like buying a car. So I love that analogy.
The real benefits, in my opinion, to using something like this, contract for deed, land contract, is that two reasons. One is that the due on sale clause is no longer an issue. Right. And the reason for it is that the bank can call a loan due once title has transferred. Title has not transferred in this case. Is it an absolute foolproof? Maybe not, but the bank would have a seriously hard time, one, finding out, and two, enforcing it. Right. So it basically eliminates the due on sale clause issue. Right. And depending on where you're doing this, as a seller, it may give you some remedies that you wouldn't have had in case of a default. In Utah, we have a forfeiture process, which would allow a seller to go through a judicial forfeiture process and get the property back in as little as 30 days. And since we have a 4-month foreclosure process here, that's certainly a much better process to go through than to foreclose. So
right, shorter time frame,
much, and cheaper.
And it's a safer, easier sell for a seller. So if you're trying to convince a seller on, a strategy for seller finance or an instrument for seller financing, contract for deed is kind of an easy sell because title doesn't transfer.
That's right. And just so that you understand this, contract for deed or a land contract really favors the seller. When we get into our next ones, they're really going to favor the buyer.
Right. Okay.
Wraparound mortgage or all-inclusive trust deed and note. And you could also say trust deed and note or just a mortgage. But the wraparound or the all-inclusive means that there's an underlying mortgage on the property and that we are creating a new note that's going to wrap around that and either have the same exact terms as the underlying loan, or we're going to create new terms, and as long as our monthly payment is as much, if not more, than the underlying payment, totally okay.
Right.
This is probably the most common type of owner finance used throughout the country. And when I say common, maybe not as a wrap, but the trust deed and note and the mortgage. Trust deed and note and mortgage would be used when the property is free and clear, has no underlying debt, and it's exactly what the bank does. When the bank gives you a loan, Jonathan, when you go purchase a property, they secure their interest either by a mortgage or a trust deed and note. That's how they are secured against the property. The property is their collateral.
Right.
The deed is going to transfer to the buyer. So the buyer is going to show up on title. There would be a violation of the due on sale clause. And isn't it funny that this is the most common type of owner financing used throughout the country, yet it violates the due on sale clause?
Yeah, it's a direct violation.
Right.
Yeah.
Really doesn't make a lot of sense, but that's the way it is.
Yeah, exactly.
In case of the default, you would have to foreclose, and foreclosure laws are different in every single market across the country, so you would need to know what that means. In some parts of the country, foreclosure may only take 30 days. It's as quick as an eviction. In others, it may be months. There may be a redemption period. Know your foreclosure laws and know which type of strategy would best fit based on what you're trying to do.
Yeah, and just keep in mind that you would probably hire a lawyer to do a foreclosure, so I don't think you need to know the ins and outs of that. And the only thing I want to mention here is with wraparound mortgages versus all-inclusive trust deed and note, it's the exact same thing, so don't get hung up on the terms here.
Yep.
Some states use mortgages, and some states, like the state of Utah, uses trust deeds. So depending on what your state uses, it's either mortgage or trust. So if you're a little confused by that, or you're wondering if they're two different things, they're not. So I just wanted to clarify that for those who don't know.
Well, and also keep in mind that you're not writing up this documentation. You're writing a purchase and sale agreement, and you are outlining what the terms are that you and the seller are agreeing to, or you and your buyer are agreeing to.
Right.
And you want to work with either an attorney or a title company that puts this paperwork together for you. So almost any title company, almost any attorney that deals in real estate can put together a wraparound mortgage or an all-inclusive trust deed and note.
Yeah.
Contract for deed, land contract, they may not all be on board with doing that. Then you got to find one that is.
Right. Cool.
This one's an easy one. I actually, Jonathan, today I talked to a title company about just doing a trust deed and note, and brand new. I've never used them before, and they totally understand it. Not an issue. And so we're going to give them a try and see how it works out.
Was it all inclusive or just trust deed and note?
Just trust deed and note, so free and clear property. But we did talk about if it wasn't all inclusive, which they would also do, no problem. And they're checking on whether they would do contract for deed.
Gotcha.
Yep. Subject to the mortgage is one that probably more investors are familiar with. Do you want to talk about this one a little bit, Jonathan?
Yeah, and the most common use of this strategy is when a property is in foreclosure. Rather than just paying off the mortgage, you can transfer title. You can buy the property subject to the mortgage or the existing debt. And so, like I said, foreclosure is the most common type. The buyer will remain on title. So their loan, the name on the loan will still be in the buyer's name. This does violate the due on sale clause, so the bank could potentially call the loan due. And in this scenario, the seller has no recourse to get the property back because they're simply just signing over the deed or the title of the property to you as the buyer. So you just got to be careful with the length of the term here. You don't. We never teach people to wholesale subject twos because you don't want to pass it on and then have your buyer, if you're wholesaling it, you don't want your buyer to default on the mortgage years down the road. And we talk about this a lot on our show. It's just because if a seller is trying to get a loan in 2, 3, 4 years down the road, and that existing mortgage is still there, they're going to have a hard time, and they're going to probably forget the length of the term that they agreed to give you as the buyer. So you want to use this more in a short-term strategy. If you're flipping the property, it's not a big deal. If you're holding it 6 months to a year, great strategy for that. If you're holding it, 3 years, 4 years, 5, 10, the remaining length of the term of the loan, then you want to give the seller some kind of recourse, and you can literally just do a wraparound mortgage or all-inclusive deed for the exact same terms of the underlying debt. But what that does is that actually gives the seller recourse to come back and foreclose on the property if, for whatever reason, there was a default and their credit got trashed again and they needed to get the property back.
I would agree. And one of the things that you don't want to do with subject to the mortgage is that, so the property I was just giving an example about that's free and clear, if I was to ask the seller to do subject to, well, first of all, there's no mortgage, so there's nothing to do, but I'd be asking him to deed over his property to me.
Right.
So the more equity there is in a property, the less chance that you're going to use subject to the mortgage. It's when there's strictly about debt relief or little to no equity in a property is when subject to the mortgage is best used. And be careful with it, because if you ever ended up in court, the judge may look at it a little bit differently than the way that you intend it to be. Yeah. Subject to means someone's deeding you the property and that loan is remaining in their name, and a judge may have a hard time understanding why someone would do that and may rule that you somehow took advantage of that seller. So just be careful how you use it, and we absolutely tell you not to wholesale subject to deals. Create all-inclusive or a wrap and do it that way. Everyone's covered. No one will be able to come back on you somewhere down the road.
Right. Good point.
Subordination. This one's not used a whole lot in the single-family residential world, although much more common on land and commercial. But it's something that I've tried to use, and I'm working on a deal right now that we'll see if we can get this accepted as a subordination. And what it means is that I'm going to ask the seller to allow me to borrow a first mortgage, whatever the down payment is that I'm offering to give the seller, against their property. So the property either has to be free and clear, or a small mortgage that can be cashed out with that down payment. Someone needs to be able to lend on this property as if it were free and clear in first position, and the seller is then going to take back a second mortgage or trust deed on the property to secure their equity. So, Jonathan, if you had a $200,000 property that I wanted to buy, and let's say I offered you $40,000 as a down payment, I would offer to borrow that $40,000 against the property to give to you, and then I would secure your $160,000 as a second mortgage or trust deed with whatever terms that we agree.
Right.
So
I'd just add, like, it's kind of more of an advanced strategy.
Yes.
Like you said, there's probably not a lot of people that even know about it, but it should just be a tool in your tool belt or your tool chest, right? And we always talk about that on the show. Like this seller subordination is a way to give your seller a big down payment. But either, like you said, has to be free and clear, or there has to be a lot of equity so that you can borrow on the property in a first position.
That's right. And so here are some good things. You won't have any issues with any underlying mortgages or due on sale clause.
Yep.
In case of default, they would have to foreclose, and that's where the real issue becomes on subordination, is that now that you've borrowed in first position, if the seller is protecting their equity, which in almost every case they would want to because they have quite a bit of equity, they would have to either keep that first mortgage current, or they would have to foreclose and take back the property and pay off that first mortgage.
Right.
That's the drawback. However, if you think about it, the seller got all of that money, so it's literally like the same thing as taking out an equity line on their property. If they took out an equity line, isn't their equity basically in second position behind that first?
Yeah. Yep, exactly.
If they sold that property, they would get, $40,000 less because they got to pay off that loan. Same thing.
Yeah, and that's probably the easiest way to sell it to a seller, I would think, is saying, hey, look, your equity's already in second position.
Yeah.
Because that has to be paid off before you can transfer title. So, yeah. All right.
Okay.
Moving on.
One more. So lease option or rent to own, and if you follow our podcast, we did an interview with Joe McCall, who's the expert in the lease option realm, and you can use these in a lot of different ways, but great way to kind of control property or even rent. Me personally, I don't want to be a landlord where I'm just renting to someone and I got to deal with maintenance and repairs, unless maybe it's on a much bigger apartment, multifamily type property. If it's a single family home, I'd much rather lease option it, because one of the advantages to doing so is that you're going to pass on the maintenance and repairs to your tenant buyer, which makes management a whole lot easier than doing it as a straight rental.
Right, and I would just add that, the majority of the public out there knows about lease options. So sellers are going to be more open to lease options or rent to own than say a subordination, for example. Right.
Yep. Well, and it's very simple if you're not familiar with it. You're basically renting it with a rental agreement, and you're agreeing to sell it at a certain price within a certain amount of time, and then the buyer has the option. So the buyer can exercise their option and purchase that property at that price at any given time during the term that you've agreed to, or they can say, no, I'm not going to exercise my option, and they have no repercussions. There's no consequences to it. Typically, the buyer will put up what's called an option deposit, which is significantly more than like a security deposit, and the seller's going to remain on title, maintain ownership, maintain tax benefits. The benefits to like a tenant buyer, they're going to be able to lock in a certain rent, they're going to lock in a price, and they can feel more like it's their home, that they're making it theirs. There's no due on sale kind of issue because title's not transferring. It's an eviction rather than a foreclosure. That's always a bonus. And like we mentioned, that you're going to get a much higher option deposit than you would as a security deposit. And there's a lot of different things that you could use lease options for. But you could work with an owner and lease option something, and then stay in the middle and pass on some different terms to a buyer. That would be called a sandwich lease option. You could do it as a lease option as if you were the seller and you don't want to deal with all the maintenance and repair kind of stuff. So there's a number of ways that you can use this. A great tool to have in your toolbox.
I would agree, and it's very simple, very straightforward. There's 2 documents, really easy to use. And there's tons of courses online, and it's just a very well-known strategy, and there's a lot you can do with it. And I think it's easy to market for anyone a property for lease. They would probably be open to doing something like this.
Yep.
So, cool.
That's it. That's all we got.
That's it. So guys, we just wanted to go over the basics here of the 5 strategies that you would use for creative financing. So this we weren't just trying to get in depth of each strategy. On the additional videos we'll go down into detail on each strategy and explain it more, but this is just a broad overview. So hope you guys enjoyed this. You guys can reach us on our podcast or on the web at www.thecreativefinancingpodcast.com. Or we have a hotline you guys can call, 877-409-8090. That's our creative financing hotline. If you guys have questions, comments, if you're looking at a deal and wondering how to structure terms, you can go there. So again, 877-409-8090. And until next time, guys, create some terms and stay tuned. We'll be releasing some more videos. Thanks.